All right, let's do a little time travel. Picture this. It's February 10th, 2026. You're in the city of London, you're looking up at all the glass towers, and inside one of them, the execs at Barclays, a bank that's, older than the steam engine, are probably sweating.
Well, maybe not visibly sweating, but definitely holding their breath.
Right, because 2 years ago, back in 2024, they stood up and made this very public, very specific promise. They told the market, look, we know our share price is lagging, we get that performance is uneven, we have a plan.
And they gave a roadmap. They set out clear targets. And today is when the bill comes due. It's report card day for their full year 2025 results.
And this isn't just, any old quarterly update.
No, not at all. This is a huge credibility test. In banking, if you set out a big strategic plan and then miss your targets, the market is, it's brutal. Investors have very long memories.
And short tempers. So the slogan was simpler, better, and more balanced. The question is, did they do it, or is that just, some nice corporate poetry?
It does have a certain ring to it. But that's our job today, right?
Yeah.
We've got the slide deck here, 100-odd pages of pretty dense financial data, and we need to figure out if the reality actually matches the slogan.
And I'm really interested in that simpler part because it's full of tech and AI jargon. But before we get to the robots,
we have to start with the money, the scorecard.
Let's do it. Okay. So, the big one, RoTE, return on tangible equity. It's plastered on, I think, every other slide. For anyone who maybe hasn't looked at a bank's balance sheet for a while, why is this the number? Why not just profit?
Because total profit can be misleading. It really depends on how big you are. RoTE is all about efficiency. It asks a simple question. For every pound of actual tangible capital that shareholders have put in the business.
So real money, not just brand value or goodwill.
Exactly. For every real pound in, how much profit are you getting out? It's the bang for your buck metric. And Barclays had a target to get this thing above 10%.
And looking at the results for 25, they delivered 11.3%.
Which is a comfortable beat. They didn't just scrape over the bar, they cleared it with room to spare.
Okay, so 11.3%. Is that actually good? Or is it just good for a European bank? Because you see some of the U.S. banks trading much higher than that.
It's a very, very solid number for a UK bank, especially one with a big investment banking arm that just soaks up capital. But what's more important, really, is how they got there.
Right.
You can juice your RoTE by taking on a ton of risk or, by selling off all the furniture.
Or firing half your staff.
Exactly. But the story here is actually about growth. Group income is up 9% year on year. That's $29.1 billion. The top line is healthy. They are not shrinking their way to greatness.
But they are cutting costs. I'm looking at this efficiency savings number. They promised $500 million in savings, but they actually delivered around $700 million. Now, when a bank says efficiency savings, my cynicism radar just goes off.
Of course.
Is this just slashing jobs, or is there something more structural happening?
Oh, there's definitely headcount reduction involved. That's always part of it. But the simpler strategy, which we'll get to, suggests this is more about fixing the internal plumbing. They kept their cost-to-income ratio at 61%. In an inflationary world where wages and tech costs are all going up, just keeping that ratio flat is a real achievement. It tells you the savings are probably real.
Okay, and then the reward, the payout. If they're making all this money and saving all this money, where's it going?
Back to the shareholders. A total payout of £3.7 billion for the year.
Break that down for me. Is that all cash dividends?
No, and this is a really important point. About $1.2 billion in dividends, so cash in your pocket. But the bigger slice, $2.5 billion, is in share buybacks.
Wow, that is a huge skew towards buybacks, almost 2 to 1.
It is, and that sends a very specific signal to the market. When a management team authorizes a buyback that big, they are basically screaming, "We think our stock is cheap."
The best investment we can make right now is in ourselves.
That's the message. It's a massive vote of confidence.
Or, to play devil's advocate, it's an admission they don't have anywhere else to grow, so they just shrink the share count to make the earnings per share number look better.
That is the cynical view, yes. But since they also grew the top line by 9%, they can argue they're doing both, investing for growth and returning the excess capital. It's a balancing act.
Okay, so the top line financials check out. They pass the test. But I want to get into the engine room. This brings us to pillar 1, simpler. Now, usually when a 300-year-old bank talks about tech, it's painful to listen to.
It can be, yes.
It's some decade-long digital transformation. But the stats here they're surprisingly specific.
They are. It feels like Barclays is genuinely trying to shed that legacy bank label. The most telling stat for me is the application count. They're cutting their number of tech applications from over 80 down to fewer than 40.
That's like digital decluttering. Does this app spark joy? No. Get rid of it.
If only it were that easy. In a bank, these things are all tangled up. Decades-old databases, reporting systems. Decommissioning half of your apps is like trying to rewire a jumbo jet while it's in midair. It's all about removing that technical debt.
And they're pushing to the cloud. From 75% in 2023 to targeting over 90% in 2026.
Which is pretty standard now, but that last 10% is always the hardest. That's where all the ancient critical mainframes tend to live.
Okay, let's get to the AI stuff, because this is where I start to get a little skeptical. Every company in 2026 is saying AI is saving them a fortune. Barclays says 19,000 of their developers are using something called GitLab Duo and getting a C.15% productivity uplift.
Right.
15%.
Yeah.
That's a very precise number. How do you even measure that? And does it just mean they're writing bad code, but faster?
That's always the risk, of course. But tools like that, they act as a co-pilot. They suggest bits of code, run tests automatically, spot errors. Look, if you have 19,000 developers and you can get even a 10% real-world improvement, that's like hiring nearly 2,000 new developers without paying a single extra salary.
So it's cost avoidance? They don't have to hire as many people in the future?
That's a big part of it, yeah. It's a huge efficiency lever. And it's not just for the coders. They mention Customer Assist in the US using conversational AI and BarkSpot in their markets division.
BarkSpot. It sounds like a cartoon dog.
It does, but it's handling foreign exchange quotations. Historically, that meant a human trader shouting a price. A bot can do that instantly, 247, and it doesn't make fat finger errors.
They claim over 1 million colleague hours were saved in FY25 from all this tech. That's a staggering number.
It is. If you figure a standard work year is about 2,000 hours, that's the equivalent work of 500 full-time employees, just automated away.
Which brings us back full circle to that 700 million in savings. The robots are literally doing the work that used to clog up the system.
And they're not stopping. The target is around £2 billion in efficiency savings by 2028. The whole thesis is, a simpler bank is a cheaper bank to run.
Okay, so the machine is running smoother. That's simpler. Let's move to better. This is about the actual business units. Because you could be the most efficient bank on the planet, but if nobody's buying your stuff, you're going out of business.
You can't cut your way to growth. You have to actually sell things.
So home turf, Barclays UK, the RoTE here is 23.1%. I have to stop you. 23% for a high street bank. That seems incredibly high, almost monopolistic.
It is extremely high. Most retail banks would kill for 15%. A number like that suggests they have a massive competitive advantage, huge moat in the UK. They have the deposits, they have the mortgages, and they're very efficient at servicing them.
And they're trying to squeeze even more out of it. I see a note here on Premier Banking.
Yes, this is a classic upselling strategy. They looked at their data and realized that half of their mass affluent customers.
Mass affluent. That's banker speak for people with decent jobs and a bit of savings, yeah.
Pretty much. People who have a mortgage with them, maybe a savings account, but they haven't been pulled into the high-fee wealth management world yet. And Barclays knows a Premier customer holds 1.6 times the deposits.
So if you could just upgrade the ones you already have.
You unlock billions in potential deposits and fees without spending a penny on acquiring a new customer.
It's the do you want fries with that of wealth management.
Precisely.
Okay, let's hop over the Atlantic. U.S. Consumer Bank. This has historically been a bit of a problem child for them, right? It's always been too small compared to the J.P. Morgans of the world. But these numbers look like a turnaround. RoTE up to 15.8% in the fourth quarter.
That is a significant jump. It was only 11.2% a year before that.
What drove that? Did they just hand out more credit cards?
In a way, yes, through partnerships. They onboarded the huge General Motors card portfolio, Instant Scale. And they bought that company, Best Egg.
I still can't get over that name.
It's a digital lending platform. But the real secret sauce in the U.S. turnaround is deposits. Retail deposits grew 34% since the third quarter of 24.
Why is that so important?
Because retail deposits are the cheapest source of funding for a bank. If you don't have enough deposits from regular people, you have to borrow money on the wholesale markets to fund your lending, and that's expensive. It kills your margin.
So they're finally fixing the funding side of the U.S. business.
Got it. Okay, last one. The investment bank. The IB. This is the bit that usually scares the horses. It's volatile, it's risky.
It's the risk engine of the group.
But the numbers look weirdly calm. Income is up 11%, RoTE is a solid 10.6%. But the key phrase here seems to be RWAs, risk-weighted assets. Can you explain that without putting everyone to sleep? I'll try. Think of RWAs as casino chips. The regulator says for every chip you want to bet, you need to hold a certain amount of your own cash in reserve. The easy way to make more money is just to bet more chips, increase your RWAs, but that's riskier.
Makes sense.
What Barclays did was grow their income by 11% while keeping their RWAs, their total bet size, roughly flat.
So they won more money without putting more chips on the table.
Exactly. That's capital efficiency. It means they're taking smarter bets or doing more advisory work that doesn't require risking their own capital. It shows a level of discipline that, frankly, wasn't always there.
So the UK is a cash cow. The US is finally growing up, and the investment bank is behaving itself. Which brings us to the last pillar, more balanced. This feels like they're trying to solve the bank's old identity crisis.
They absolutely are. For decades, Barclays was seen as a hedge fund with a retail bank attached. When the markets went south, the whole group went south. They are trying to shift that mix toward more boring income.
And boring is good.
In banking, boring is beautiful. They want more fee income, more steady lending interest, the kinds of revenue that show up rain or shine. And they've set a huge new target for 2028, a group RoTE of over 14%.
Whoa, hang on. We just celebrated them hitting 11.3. Getting to over 14% in just a couple of years, that's a massive leap. How on earth did they get there?
That is the ambitious part. They're targeting more than 5% annual growth in UK lending mortgages, business loans, the lot.
But the UK economy isn't exactly firing on all cylinders. 5% growth means they have to be taking market share from somebody else.
It does. It's an aggressive goal. And they want to grow fees from wealth and transaction banking. The idea is to have these stable businesses grow faster than the volatile trading business.
And the prize for all this? They're promising to return over £15 billion to shareholders between 2026 and 2028.
Which is just a colossal number. For context, that's a huge chunk of the bank's entire market value handed back to investors in just 3 years. It's their way of saying, we are going to be a cash machine.
It all sounds great. But I have to be the skeptic again. This is all happening in a vacuum on a PowerPoint slide. I'm looking at their risks page. Geopolitical uncertainty, credit uncertainty, the interest rate cycle.
The usual rogues gallery.
But let's talk about the structural hedge. This thing pops up as a massive driver of the 2025 results. It brought in $5.9 billion of income. What is that?
Okay, imagine you have billions in customer checking accounts that you pay almost zero interest on. That money is very sticky, it doesn't move much. Barclays takes that sticky, cheap money and invests it in safe, longer-term government bonds.
Right.
When interest rates shot up a few years ago, they locked in those high rates. Now, even if rates start to fall, they have this big portfolio, the hedge, that's still churning out huge interest payments.
So it's like they got a really good fixed-rate mortgage, but they're the ones getting paid.
That's a perfect way to put it. It's a massive shock absorber. It provides a floor under their earnings, a huge tailwind.
But tailwinds don't last forever. As those bonds mature, they'll have to reinvest at whatever the new lower rate is.
And the income from the hedge will drop. That is the risk. They're riding a wave right now, but they need the better and more balanced strategies to kick in and replace that income before the wave hits the shore.
So to bring it all together, Barclays in 2026. They've moved from stabilization to growth. They hit their numbers. The tech overhaul seems real.
It does. Phase 1 of the turnaround looks like a success.
But here's my big question for you and for everyone listening. The whole bet here is that a 300-plus-year-old institution can basically become a tech company. They're relying on GitLab and Copilot and BarkSpot to keep costs down forever. And sure, they hit the numbers this year, but we're in a pretty calm credit environment right now.
That is the key variable, yes.
What happens when the next recession actually hits? Can this new AI-driven, decomplexified bank handle a real crisis better than the old, heady, human-powered bank? Or do we find out that automating everything and removing 40 apps also removes some of the hidden safety rails?
And that is the billion-dollar gamble. Efficiency is wonderful when the sun is shining, but redundancy, having extra people, extra systems, is what saves you when things break. Barclays is betting they can be both lean and safe. We'll only find out if they're right when the next storm hits.
And in the markets, there's always another storm coming.
There certainly is.
Well, that's a cheerful thought to end on. We will be watching that 14% target very closely. And that is it for our deep dive on the Barclays FY25 results. Thanks for listening. Maybe go ask an AI if it can optimize your budget, but don't blame us if it tells you to stop buying coffee.
Or if it suggests a share buyback of your own furniture.
See you next time.